TheoTrade. This is Don Kaufman. It's April 18th, 2019, and you are watching the TheoTrade Weekend Update. So, we had a shortened week, obviously, because of the holiday weekend. Here we are. It's Passover. It's Easter weekend. We're going to do a quick week in review. Then we're going to jump forward. We're going to look at everything from implied volatility to historic volatility to what I can only term in this marketplace as a market that's contracted in terms of historical and implied volatility for a protracted period of time. When we get to the charts, I'm going to show you precisely what that really breaks down to. Remember that. Contracted for a protracted period of time. Nevertheless, there are some very specific sectors and ideas that we want to talk about moving forward. One of those, which of course was that the SPX itself, I mean, if you looked from Friday, that's last Friday, to today, and today being April 18th, so you had the last 4 days of trade. You know, the S&Ps net, they moved down a whopping 2 points. I mean, again, last Friday they closed at 29.07. This Thursday, of course, the end of the trading week, this Thursday they closed at 29.05. We had a massive 2-point move throughout the course of the week. But at the exact same time, I'm saying that some of the intraday trade wasn't half bad. We actually saw some decent volatility really early on in trading sessions, and it just kind of petered out, of course, as the trading days went on. The other aspect I want to bring to your attention right up front, which again I'm going to show you here in just a moment, has everything to do with the fact the Nasdaq actually clipped into all-time highs on the back of, think about this, Qualcomm, right? Apple, of course, Apple. Microsoft is a stock that's actually just forging forward. Intel and Google. Those are the big players that actually drove order flow and taking the Nasdaq effectively to all-time highs. Now, the reason I'm talking about some specific sectors to begin with here, well, we've got earnings coming up, and we heard from some of the earnings of the financials. Now, last week I told you, don't read too much into the financials. It's always going to be kind of a mixed bag of goods. One of the things, though, that I pulled out of the financials, a few of the firms actually missed on revenue. Now, that doesn't mean that their profits, okay, were absolutely horrible, but they missed on revenue. But if you look at a lot of the financial stocks, like on a one-year chart, well, the financial stocks, they're down over the last year. In fact, we're actually going to take a position here specific to JP Morgan, and I'll show you that here in just a couple of minutes. So the XLF, specifically the financials, they did rise on the week. But again, I'm a little bit bothered by the fact that their revenues weren't necessarily spectacular on a number of the key financials. As I said, kind of a mixed bag of goods. Now, why a little bit of the cautious tone? Well, the cautious tone is because, again, the Nasdaq hits an all-time high, and this next week of trade, yeah, guess what? You're going to have a lot of Nasdaq stocks that are going to be coming out swinging with their earnings, and they better hit their numbers, and they better hit their revenue numbers, not just about profitability, all right, but are they actually bringing in the bucks? And that's something that the street is going to be looking for extensively. To continue on this sector idea, you know, you got to talk a little bit about healthcare because it got decimated this past week, and hey, from my perspective, I like it. Why? Because I've got a short position inside of the XLV, which we'll show you here momentarily. The other aspect that you have to be mindful of, and again, before we get into some of the charts, some of the option chains, the Russell. Why am I talking about the Russell? Because it was down this week, and in a lot of the previous moves that we've seen, and specific really to 2018, the Russell was on the forefront of those moves. Now, I kind of cautioned about this a bit in the during the week on one of the videos. You know, again, the Russell, is it still kind of leading the way, or is this just a bunch of healthcare stocks that are dragging the Russell under? It's a little bit of both, and that's exactly what we're going to show you here, but we're going to take a much more detailed look into, rather than just the Russell, what's the Russell doing in terms of volatility? And I'm going to answer that here momentarily. The next thing I do want to cover here is a little bit about the SPX. So the SPX, the options only product, the expected move for this coming week, which is a full 5-day week, is going to be about $32, which is inherently low, which is exactly what you would expect. As I said, it's contracted volatility for a very long period of time. And one real shocking thing that I'm going to show you here first when we get into the charts is that the historical volatility, if you don't speak geek, historical volatility is, well, here. It's the actual price movement of a stock. And averaged over the last 5 days, it's been about 5.5%. So if you look at, like, people are looking at the VIX and they're like, oh, the VIX is dropping all the way down to 12, or it's dropping down even to the 11 region. Well, guess what? Actual movement in the marketplace over 5 day, okay, kind of rolling period is sitting at 5.5%. That's brutal, right? Okay. The other aspect I want to bring to your attention over here has everything to do with what we term low beta. Low beta, which is supposedly supposed to be, again, low risk. We're actually going to look at the utilities. All right. So again, I'm going to get very sector specific in a marketplace that you're looking at and you're like, oh, this is kind of a boring marketplace. We haven't done anything. There's actually a lot going on in terms of sectors. Now, why am I bringing up the utilities and talking about low beta? Because for some reason, those low beta stocks, not making a whole lot of sense. Those low beta stocks, they are on the move, okay? And with those low beta stocks being on the move, and it's almost inexplicable, you also have bonds, okay? Bonds plus the utilities, all right, it doesn't add up when you start looking at the equity markets. With that, let's get to it. Let's actually get to some charts, some option chains, talk a little bit about implied volatility, historic volatility, get to it. To the charts and trades we go. Allow us to start here on the charts. Specifically, we're looking at the spiders. I'm going to go ahead and close up that left side bar on thinkorswim. And I just wanted to bring to your attention, again, the historical volatility. Again, it's the annualized standard deviation of the past stock price movement. Yeah, I had to geek out on you there for a minute, but it really means is, again, how much is this little monkey actually moving? And in this particular case, I'm kind of looking at historical volatility over the again, it's a 5-day period. Normally it defaults to about 20-day period. But I wanted to give you a feel for what the historical volatility looks like, again, kind of in the shorter term. And the answer to that is, again, there we go. It's effectively that works out to 5.5%. And it's been rather consistent for a period of time. Now, when somebody asks what's going on in the market, if you just look at the spiders in the last, 4 or 5 days, you'd say absolutely nothing. It's massively unchanged. Look at the S&P futures, and the number I've been screaming out again incessantly over the last couple of weeks is 29.11, and that's exactly where we effectively closed in today's trading session. Nevertheless, okay, I'm going to show you some interesting areas, and for that, I'm actually going to cruise over to the SPX. One of the things I want to bring to your attention inside of the SPX, and I'm just going to zoom in on this, is the year at large. These are expected moves. This is, again, we draw these, again, on a weekly basis, and it's how the options market depicts risk, okay, for the future week. And I'm just drawing these expected moves on a week-to-week basis. Effectively, what I am doing, and again, I'll close up this left side bar, what I'm doing is, next Friday is April 26th. I'm just going to highlight this for a second. So I take the April 26th expected move, which is right around, let's just call it $32.20, okay, and I just draw on the chart, okay, this central point. All right, and the central point right in here, that's where we currently are. Then I just draw a line, effectively $32 higher and effectively $32 lower. And that gives us, okay, the expected move. Now, what is, again, an expected move? And what it really breaks down to is it's a 1 standard deviation move. So if you look at expected move, okay, as a distribution, we're supposed to stay inside of that range. And that's $32 higher or $32 lower, okay, and we're supposed to be inside that range, of course, at the end of the week. Now, if you looked at the mathematics of this, and I'm going someplace with this, but if you looked at the mathematics of this, okay, how has expected move performed, all right, thus far on the year? Well, there's 16 weeks. We're 16 weeks into this year. If you want to count this one over here as a breach, again, every one of the breaches I have highlighted. This is a breach of expected move, but it's only by about $3. I think that one is almost, it's kind of like it's a mulligan. It's a do-over, but we have 1, 2, 3, 4, 5 breaches. Okay, if you were to take a look at this, and again, we could just come to our trusted calculator and you say, all right, you've had 5 breaches over 16 weeks. What does it come out to? 31% of the time we're actually breaching the expected move. Well, is that close enough for you? Is that close enough to the 68% of the time? But the fact of the matter is, just because we're, inside of the deviation, what we're supposed to be, what you have to recognize, again, is not only the implied volatility, but the historical volatility aspect of this. And we have seen, again, when you're in a contracted historic volatility situation, okay, for a protracted period of time, you will expect, all right, almost, if you will, like a rupture of this expected move. And I actually went back, by the way, I have a huge amount of data on this. Huge. Okay. How much data do I have? Well, I've hand drawn expected moves for over 2 years, but I also have our trusted little auto expected move study. On an auto expected move study, I can go back as much as 5 years. And one of the things I was able to do is there's a script written inside of the expected move, and this is an auto expected move. There's actually a script written inside of here, so I can go back and actually look at the number of touches, the number of like, did we exceed expected move by the end of the week? And I can look back at that. And one of the things I found is that when you are in this protracted period, again, of extraordinarily low historical volatility, that we come out swinging at the end of it, which is kind of exactly what you would expect. And I don't want you to be like surprised by that, but I caution you at this point in time, okay, if you're allocating capital, and I was talking about this last weekend too, but if you're allocating capital, doesn't matter where you're allocating capital, you need to be aware that the marketplace might be poised for a more substantial move. Now, trying to time that, I think, is an impossibility. I was talking about that also last weekend, but it's very, very apparent right now, again, given the fact that there's this 5.5% historical volatility. Now, with that, let's move on a little bit. Let's actually cruise over to the Russell for a second, because there's a bit to talk about with the Russell. The Russell, and I'm actually going to pull up auto expected moves in the Russell. And the reason I'm using the auto expected moves, I don't hand draw everything in every single product. So I use this auto expected moves script, which is almost as good as drawing them by hand. Well, the Russell actually finished towards the lower end of the range. Now, you can point fingers and you can say like, it was healthcare, it was this, but it doesn't really matter what sector actually dragged it down, does it? Okay, it just matters that the Russell has defected a little bit. The other aspect I would bring to your attention is the Russell. The Russell is not anywhere near its all-time high. Okay, so we have Russell right here, and this is effectively the all-time high. Okay, so we're almost 200 Russell points away from an all-time high. Whereas if you were to look at the Nasdaq is very close to the all-time high, effectively hitting the all-time high. The S&Ps are a stone's throw off of it. So the Russell, you got to keep your eye on it. And again, I'll bring up some of the most recent trade, if you will. Here's the big defection of the Russell, and that actually happened again in the early September, late August, early September timeframe when the Russell started defecting first. The Russell also went in a pretty precipitous slide before the rest of the market. Okay. In fact, the Russell almost was on the forefront of the sell side activity even before the December move happened in the remainder of the marketplace. The other aspect, the Russell, it just hasn't recovered. And this bothers me. Now, it bothers me not just because it's the Russell. Okay, it also bothers me on the front of the implied volatility. The implied volatility inside of the Russell, to me, actually looks a little bit low versus some of the action inside of the Russell. There could be some opportunity in there. Again, I don't have time necessarily to go into detail in this weekend's video, but I'll kind of detail that a little bit next week. That, again, there could be some implied volatility opportunities in the Russell, because we all know when this thing gets moving and the Russell gets a rocking, that can be, again, quite advantageous. So as I said, the Russell, it bothers me a little bit that it is starting to defect. We'll see if that actually carries through it all next week. Okay, but it's not just the Russell. It's the Russell in conjunction, okay, with bonds. So why am I bringing up bonds? First and foremost, the bonds, okay, we're coming into a holiday weekend, and the bonds, I mean, these things this morning, they were a trading. All right, there's some activity in the bond market. There's some umph behind it. I mean, this morning, these bonds, these guys were firing in there this morning. And the bonds, it's not like, okay, don't worry about the short term. The picture that I'm trying to paint for you in the bonds is they just still haven't backed off. Like the bonds, okay, versus the equity market, this doesn't make a whole lot of sense. Is that, I'm being told every day, well, maybe the economy is getting a little bit better. Well, if the economy is getting better, wouldn't we expect the Fed maybe to turn a little bit more hawkish? And for that, when I say the Fed's going to turn more hawkish, I bring up the treasuries. This is the TNX. This is 10-year, all right? And that 10-year, what's it sitting at right now? Just sketch it on your screen over here. That 10-year is sitting at about 2.5%. So what doesn't make a whole lot of sense is, so we have the Russell looking a little volatile, like it's defecting, going to defect at the downside. And what bothers me even more than that, again, is the interest rate in the marketplace right now. If the economy is getting better, okay, those rates, they should be going up. The marketplace should be dictating. The marketplace should be on the forefront of this. It doesn't matter per se what the Fed is saying, okay? This is the 10-year. That 10-year should actually come up a little bit. I mean, the yield curve is not inverted right now, but it's really, really close to being inverted in an economy that I'm supposed to, tell you that that's getting better, okay? Well, it's not until the treasuries say it is, because this is where, okay, capital flows right here inside of the treasuries, okay? And at this point in time, given the fact that the rates are so incredibly low, like, all right, that plus the Russell, but the Russell barely defecting this week. All right, well, on top of just the rates over there, I got to bring up the XLU, because the XLU is in cahoots with the bond market. Okay, the XLU is the utility sector, and I look at the utility sector a tremendous amount. All right, listen, when people are typically scared, okay, or they're looking for a higher yield, listen, the XLU is yielding like 3%. There's some dividend out there; it's like 3%. If they're looking for higher yield, or they're a little bit scared, they typically tuck some capital into the XLU. Now, it almost looks like the XLU could come down, but it hasn't. Okay, so we have an equity marketplace. When I say the equity marketplace, I'm talking about the spiders. Let's just, bring up the spiders, if you will. We have an equity marketplace. In fact, you can even bring this up. Let's get crazy. All right, you can even bring it up side by side. Bring up the spiders in here, and this is roughly the same time frame. Here's a 9-month chart. Here's a 9-month chart. Bring them up side by side. We have an equity marketplace that is just ripping to the upside. We have the utilities that are ripping to the upside, and the bonds that just refuse to back off. Okay, again, it just doesn't add up. The other aspect that really is bothersome in terms of the utilities, okay, the utilities are actually throwing off decent amounts of volatility. Check this out. The utilities, okay, they're like a 12-13% implied volatility. They're throwing off decent amounts of implied volatility. And to further that, a moment ago I was showing you historic volatility. If you don't believe in the implied volatility, maybe the options market's wrong. Fine. Okay. Well, is the actual market wrong? Because if you go over here and you come over to volatility studies, you come over to historical volatility, right? Historical volatility, now this is averaged over 20 days, is still sitting at about 10%. In fact, I can edit this down because I was looking at the 5-day, kind of rolling 5-day, and edit that down, hit apply, hit OK. Yeah, it's actually slightly over 10%. So do you realize that the utility sector, which is supposed to be the most docile animal out there, is actually moving at a rate right now of almost double, and actually it is double, of the spiders. There's a lot of things on the screen right now, okay? Again, they don't make a whole lot of sense. Speaking of that, I'm also going to bring up the TLT, because maybe you understand the TLT better than the ZB, which are the bonds, okay? The bonds right now, the bonds are actually moving, okay? Historical volatility is at a higher rate than the spiders, because we just said the spiders the other day, okay? We're averaging this 5.5, and I brought that up like 3 different times in this video, 5.5, yeah? Well, the TLT is now moving more than the spiders. So get that, okay? The products that are kind of what they call like risk on, risk off, yeah, well, the products that people typically use to duck and cover are actually having a higher rate of movement, real movement, than the equity markets. And I'm telling you, all right, a lot of this stuff, again, it just does not add up. Now, I'm going to blank the screen for a minute. Okay, let's cruise over to the financials. In the financials, okay, the financials did end the week higher. In fact, I'll turn on the auto expected move. All right, where do the financials start the week? Right here, 27.14. Where do they end the week? 27.33. It's higher, but it's negligible. Again, the financials, it was almost like, as I said, like a mulligan, like do-over, because we had a financial one that was good, one that was bad. The one that I'm going to single out, though, over here is JP Morgan. Why am I singling out JP Morgan? First of all, for those of you that have been around at TheoTrade for any period of time, you'll know that I've shorted JP Morgan time and again. And I got out of a duration position. Again, I got out of a duration position in JP Morgan right back in this neighborhood here. In fact, I bailed out of this position right when JP Morgan was trading 102. All right, we rode JP Morgan down for quite some time, sold some premium against it. We laughed, we cried. Well, today I actually reinitiated the position. I like it. It's pumped right back up into the neighborhood when I initially shorted it. How did I actually short JP Morgan? I did not go out and physically short the shares. I'm in an IRA. So what did I do? I used a 125, a June 125 put. It's right now it's trading at about a 1 delta. It wasn't earlier. Okay, when I executed this position, and listen, this position, I got this on in a couple of accounts. It's not necessarily for the faint of heart. Each contract is going to cost you, about $1,200 of risk, just shy of $1,200 of risk. Okay, but this is a stock that it actually reversed a little bit already. We're already up 10% on the position. Nevertheless, coming into next week, if JP Morgan bids a little higher, you might be able to get into that. Again, I'll recap that a little bit in the chat room throughout the course of the week. All right, last but definitely not least. Again, we're covering a lot on this weekend's update, and you thought it was a docile week. Even in a docile week, there's always stuff going on kind of, beneath the seams of the market. The last thing I want to bring up, okay, is scan for the earnings, all right? In earnings, there's a ton of earnings coming up. Now, we do have some of the what I term the monsters of tech that are going to be coming out with earnings. All right, we're going to hear from the likes of Facebook. Again, I can go on and on and on. There's a lot of earnings coming out, right? Ooh, Snapchat, I can't live without that one. I'm just kidding. You got Facebook, you got Microsoft. Microsoft is critically important, okay? I mentioned Microsoft moments ago, and let's try that again. I mentioned Microsoft moments ago, and I'm actually clicking on Microsoft, and it did not want to populate. It just doesn't feel the love over here. So there we go. Microsoft. This was actually leading the Nasdaq, leading to the upside of Microsoft. So that is going to put a lot of pressure on the earnings over here. And this is one that will very likely trade. There's only about a $4 expected move as of right now. And a $4 expected move in a $120 product. Again, they're not expecting like a rockin', move. But this is absolutely, okay, either going to take the Nasdaq to all new highs again and again, okay, or it's going to decimate the Nasdaq. You got to look at Microsoft. The other one that I would actually be very mindful of that's probably off everybody's radar screen, you better look at Boeing. Okay, because Boeing can rock the Dow. You rock the Dow, you rock the S&Ps, you'll take everybody along with you. Boeing is coming out with earnings this next week, all right? And there could be, again, a lot of news involving this Boeing 737 MAX. Those are the two that are really going to be on my mind throughout the course of the week, and I'll highlight, again, early on in the week. With that, again, a lot to think about on this weekend's update. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend.